So hello and welcome back to our YouTube channel everyone, and here is the part 4 of the moving averages, which is going to be the very important one, because in this part of the moving average series what we are going to do, we are actually going to give you the trading setup that you can place on any chart and then you can take trade based upon them. So friends, I hope all of you have watched the previous three parts, because this is in line with those only. So if you have not watched them, then you can go to our channel and you can watch the previous three parts so that you can build up all the basic knowledge to reach to this one. And because in this part we are going to actually finish the things off, so we are going to use some previous knowledge also. So if you don't have it, then you should go and grab it. And the chart I am using is from the Zerodha. I'm not using any other trading platform, because while using the moving averages, I watched the different trading platforms, but I thought that Zerodha is the best one. It is giving the best visualizations. That's why I have selected this. If you want to use any others, then you can do that. I am particularly using Zerodha. And please do watch the previous three parts before watching this one. So okay, now let's begin the video. So moving average settings, we are going to talk about the moving average settings, because now we have all the knowledge about the simple moving average and the exponential moving average. Now we are going to set the moving averages. About the simple moving average, in the second part itself we have talked about what is going to be the setup for the only simple moving averages. And now in this part, what we are going to do, we are going to use the multiple moving average, so to see how does it work. So moving average settings: once a security has been deemed to have enough characteristic of trend, the next task will be to select the number of moving average periods and type of moving average. The number of period used in a moving average will vary according to the security's volatility, trend lines, and personal preferences. The more volatility there is, the more smoothing that will be required, and hence the longer the moving average. Stock that do not exhibit a strong characteristic of trend may also require longer moving average. There is no one set of length, but some of more popular lengths include 10, 20, 50, 100, and 200 and days, as well as 21, 50, and 89 weeks. So short-term traders may look for evidence of 2-3 week strengths with 21-day moving average, while longer term investor may look for evidence of 3 to 4 months trend with a 50 moving average, while average trial and error is usually the best means for finding the best length. Examine how the moving average fits with the price data. If there are too many breaks, length the moving average to decrease its sensitivity. If moving average is slow to react, shorten the moving average to increase its sensitivity. In addition, you may want to try using both simple and exponential moving averages. Exponential moving average are usually best for short-term situations that require a responsive moving average. Simple moving averages work well for long-term situations that do not require a lot of sensitivity. Okay, now we are going to use multiple moving average for the signals. These are the moving average general thoughts about the simple moving average settings that one can use based upon your style of trading and your preferences, and depending upon the volatility of a particular stock or indices that you are analyzing. Now let's see the signals of multiple moving average. It is usually advantage to employ more than one moving average. Double and triple MAs are often provide useful signals. With two moving average, the double crossover is used. A buy signal is produced when the shorter average crosses above the longer, and vice versa for the sell signal. For example, two popular combination are 10 and 20-day average and the 50 and 200-day average. The technique of using two averages together lags the market a bit more than a single moving average, but produces fewer false signals. So we are going to use both these moving averages. Okay, now you can use simple or you can use exponential, whatever you like. Right now we'll try both exponential as well and simple as well. So let's put first a 10-day exponential moving average. Okay, so let's change the setting of this moving average. Edit setting, and we are going to use this is the Infosys daily chart. Okay guys, exponential is the type 10. We have selected the period 10 and then we are going to use 20 with it. So studies here, again going to add another moving average. this is going to be a period of 20, not we are going to use exponential. Done. Okay. So by signal, when the shorter one goes about, this is the 10 and this is the 20. Okay, so here you can see 10 has came above the 20. This is 20, this is 10. So here you can see particular, here you can see the 10th day moving average came above the 20-day moving average. So this is a buy signal. Okay, so here it came down but then go below it, sustaining about it. So this stock is in a buy mode, and here is a WISPO, the false signal has been given. But here again the shorter moving average crossed the longer 20-day moving average from below. Let me change the color for you. Let me change the color of 10-day moving average to yellow. Okay, now so the yellow one is the shorter moving average, and whenever the shorter one cuts the longer one from below and goes above, then there is a buy signal. And you can see here the right buy signal was given by this trading system. And if the shorter moving average cuts the longer moving average from above and goes below, then that is a sell signal. And here you can see the longer moving average, the shorter moving average, the yellow one cuts the longer one from above and goes below, then there is a sell signal. And you can see it's a brilliant sell signal. We have booked a good amount of profit. So this is a direct to use trading system for everyone, whoever wants to trade. Okay, for longer periods, if you are someone who wants to take trade for like 1 month, 2 months, then you can use the combination of 500 or 200 day averages. It's up to you only. Whatever you would like to use, depends upon you, and you can use based upon that. Okay, and the same way it will give the signals. But the thing is that as the longer moving averages you will use, they will give you less false signal, but with that they will give you less signals also. Like this moving average, the 10 and 20 combination will give you a lot of opportunities to trade. Like again here you can see this, again it has given a buy signal, and we have seen 2-3 signals it has given. But with the longer moving average you will find very less signals being there, but again they'll not give you much false signal. So there are the advantages and disadvantages. Now what we are going to do is we are going to see a triple moving average combination. Okay, so what combination are we going to use is 10, 20 and 50 day moving average. Okay, now we are going to day 10, 20 and 50 day moving average. While using double moving average, we have used exponential moving average. So now let's use simple moving average for this triple crossover. You can use EMA in this also, but we are going to use simple only. 10, 20 and 50 simple. Okay, this is also, let me turn this also to simple. Now I am going to add another one of 50 moving average. Simple. Let me change the color to blue, darker shade of blue. Okay, here it is. Now go long when middle moving average, middle is the red one, okay, our 20-day moving average or 20 moving average crosses to above slow moving average from below. And okay, go long when this crosses the slow moving average, means this blue one, from below and go above. Look at this, then you can go long on the particular stock. Okay, and the fast moving average must be above this middle one. So here you can see the red one, the middle moving average goes above the slow moving average from below. It goes above the blue one, and the yellow one was above it. So you can easily long the stock at that moment. And when to short? To short is when the middle moving average goes below the slow moving average. Means if the red one, the 21 goes below the 51 and the 10th one is below the 21. Okay, you can see the setup. The 20 is in the middle, the 50 is above, and 10th is below everything. So then you can short the stock. And here the red one, 21, is going above the blue one, the 51, and the yellow one is above that. So at that situation you can long the stock accordingly. So these are the setup using the crossover of double and triple moving averages. So I hope now you understand how to use different moving average. You can use any combination of exponential moving averages or simple moving averages for short-term trading. I have told you if you are using double moving average, use 10 and 20 for best uses, and if you are using triple, then use 10, 20 and 50. For long term trading, you can use a combination of 50 and 200, and you can also use 21, 50 and 89. This is the most popular setup used by the traders: 21, 50 and 89. Okay, so you can use accordingly any combination of double and triple. And this is not the thing that whatever I am telling you, you have to do that only. You can also go and try different moving averages, and you can select which moving average suits best to which stock or which indices, and you can use based upon that also. So with this, our moving average series has ended. So I hope all of you have learned a lot, and you know how to use the moving average, how to calculate the moving average, and what are the other uses of the moving average. So thank you so much for watching this video, guys. Please do like this video, share this video with your friends and family. Don't forget to subscribe to our channel, and please press that bell icon, that lovely bell icon, to receive daily notification about our videos. So thank you so much for watching once again, everyone.